Welcome back to Smart Stock Sam, the channel where institutional-grade intelligence meets the everyday retail investor. Today, we are going forensic on DataVault AI, ticker DVLT, and I am going to show you exactly why the convergence of a federal securities lawsuit, a CEO stepping onto a major national stage this weekend, and a deeply coiled technical spring could combine to create one of the most asymmetric setups we have analyzed heading into the week of March 16th. We are dissecting the Scilex lawsuit and what it actually means for price action, breaking down the CEO's live presentation catalyst, and locking in next week's precise price targets with surgical accuracy. All of it, right now. But before we go anywhere, I want you to sit with this one question. If the world's biggest, most sophisticated funds are accumulating this stock at 3,000% increases, why is the price still trading at a fraction of what Wall Street analysts say it is actually worth? That curiosity gap, that disconnect between what the institutions know and what the price currently reflects, is exactly what we are going to bridge today. But to understand where we are going, we first have to see exactly how we got here. Last week, we laid out a very specific roadmap, and I want to revisit it with precision because the market gave us something rare. It validated nearly every level we called with what I can only describe as surgical accuracy. We identified a proven floor sitting between 64 cents and 67 cents, and we told you that institutional defense would show up right there if the selling continued. Hold on to that. Beyond the specific price levels, we outlined three structural pillars that form the entire backbone of this thesis, and each one of them is still firmly intact. Pillar 1 is the entry zone and its proven floor, a price range where institutional buyers have repeatedly demonstrated their willingness to absorb selling pressure and defend the position. Pillar 2 is the valuation disconnect that is almost hard to wrap your head around. Wall Street analysts have a consensus price target of $4.08 on this stock. That represents 497% upside from where DVLT is currently trading. And before you dismiss that as optimistic, consider this. Comparable AI sector peers are trading at 8 to 15 times their forward sales multiples, while DVLT is sitting at a forward price-to-sales ratio of just 2.0 times. That is not a mild discount. That is a company trading at a fraction of what its sector peers command, with revenue growth that actually justifies a much higher multiple. Pillar 3 is what I call the coiled spring. There are currently over 84 million shares sold short in DVLT, representing 26.02% of the entire float. Now think about what that actually means mechanically. Every single one of those short sellers eventually has to buy shares back to close their position. Every one of them. So ask yourself honestly, what happens when a stock carrying this level of short interest suddenly receives a surge of institutional buying volume on top of a fundamental catalyst? Could that combination be the match that finally lights this powder keg? Or is that outcome simply too obvious for Wall Street to let happen easily? Now let us look at the actual tape from last week and see whether our roadmap held up under real market pressure. If you were with us last week, you already know the answer. And if you are watching for the first time, this is the moment where the analysis gets impossible to ignore. Between March 9th and March 13th, the technical validation was absolute. The market did not just respect our levels, it confirmed them with a precision that reinforced every element of the thesis. On Monday, the broader market was getting absolutely hammered. Traders were reacting to what analysts are now calling warflation, a toxic cocktail of geopolitical escalation and inflation data that sent volatility spiking across every sector. In that environment, DVLT hit an intraday low of $0.6433. That was our predicted absolute worst-case level. And right there, at that exact floor, the institutional defense was immediate and visible. The selling dried up. The bid held firm. The floor did exactly what a structurally supported floor is supposed to do. It held. For the remainder of the week, the stock continued to defend the 67-cent level, which we specifically labeled the definitive line in the sand. Then, on Thursday, we saw a mid-week relief rally attempt push the price up to 74 cents. a move that looked promising on the surface, but it was rejected cleanly before reaching the 80-cent resistance wall. And the reason why tells us everything. That rally attempt happened on volume that was 75% below the average session volume. There was no institutional participation behind that move, no big money confirmation. Without the volume to sustain it, the momentum had nothing to feed on and simply faded. But here is what I want you to think about. Does a rejection on anemic volume mean the breakout thesis is broken? Or does it mean the breakout is simply waiting for the one catalyst that forces volume back into this name in a way that cannot be ignored? That lack of volume was not random. It was not coincidence. There was a fundamental bombshell dropped on Friday that explains the entire week's price action, and it changes the picture completely. On Friday, March 13th, a federal securities fraud lawsuit filed by Scilex Holding Company was formally unsealed, and the allegation sitting at the heart of it is staggering. The lawsuit claims the unauthorized transfer and systematic sale of approximately 96 million DVLT shares by third parties. Shares that were never legally authorized to hit the open market, yet somehow found their way into the trading float and were quietly sold into unsuspecting buyers. Let that number sink in. 96 million shares of what the lawsuit describes as illegal selling pressure, systematically depressing the price of this stock while legitimate investors watched the chart and wondered why it was not moving the way the fundamentals suggested it should. That unauthorized supply is the distinct and identifiable cause of the 2.8% decline we saw on Friday. It is the reason the price has remained pinned near its lows, despite the extraordinary and documented institutional accumulation happening simultaneously. This is not a company with broken fundamentals. This is not a deteriorating business. This is a stock whose price is being artificially manufactured lower by supply that, according to the lawsuit, should never have existed in the first place. And that is the core thesis. We are witnessing artificial compression at its most textbook. The gap between the current market price and this company's intrinsic value is not just wide. It is being actively widened by forces that a federal court is now being asked to stop. Is it even remotely possible that once this unauthorized selling is legally halted, the price correction back toward fair value happens in a calm and orderly way? Or does 96 million shares of suppressed demand release all at once? So if artificial compression is holding the price down, what does the true fundamental value of this company actually look like? The numbers tell a story that the current chart price simply refuses to acknowledge. Analysts at the Maxim Group have an independent buy target of $4 even. The consensus mean across all covering analysts sits higher at $4.08. These are not speculative numbers pulled from thin air. They are discounted cash flow models and revenue multiple analyses built on a trajectory that management is actively executing against in real time. Earlier this year, management took the extraordinary step of raising their 2025 revenue estimate, moving it from $30 million up to a range of $38 to $40 million. That is not a minor revision. That is a company telling the market that business is accelerating faster than originally projected. And beyond 2025, management is holding firm on a $200 million revenue target for 2026. You are looking at a business that is scaling aggressively, raising guidance, and trading at a sector relative multiple that implies either the analysts are all wrong or the price is being artificially suppressed. Given what we know about that lawsuit, which explanation do you find more credible? For the disciplined, patient investor, the message here is straightforward. The setup is not broken, the setup is compressed. And there is a meaningful difference between the two, because compressed setups release, while broken ones do not. And while retail investors are scrolling past the lawsuit headlines in fear, the institutions are doing something that requires you to pay close attention. Since late 2025, BlackRock has increased its position in DVLT by 3,000%. Vanguard has grown its stake by 2,900%. State Street is up 2,800%. Combined, these three institutions now hold between 4 million and 12 million shares each. and they built those positions in a period when the price was being suppressed by that very unauthorized selling we just discussed. They were not buying despite the chaos. They were buying because of the price the chaos created. Now ask yourself this with complete seriousness. Is there a realistic, non-negligible chance that BlackRock, Vanguard, and State Street, three institutions that collectively manage tens of trillions of dollars in assets and employ some of the most sophisticated analysts in the world, are all simultaneously making a catastrophic error in judgment on a single small-cap AI stock? Could all three of them be wrong at the same time, in the same direction, by 3,000%? Meanwhile, the short sellers are burning money while they wait for their thesis to play out. With 84.86 million shares short and annual borrow fees ranging between 21.4 and 25.1%, every day these positions remain open is another day of compounding cost. The moment any meaningful catalyst drives even a partial wave of short covering, that buying pressure feeds on itself, creates upward price movement, triggers more covering, and the cycle accelerates. The setup for that sequence is fully loaded. It just needs a spark. And this weekend, we may be looking directly at one. March 14th and 15th is Oscars weekend in Los Angeles, one of the highest profile media and entertainment events of the year. And DataVault AI CEO Nathaniel Bradley is not watching from his couch. He is taking center stage at the Luminary 2026 presentation, where he is scheduled to debut the tokenized legacy platform and deliver a live demonstration of their proprietary ADO technology to a room filled with high-profile investors, media figures, and industry insiders. Think about the timing and the context simultaneously. You have a stock that is technically compressed, institutionally accumulated, and carrying the heaviest short interest in its recent history. You have a CEO stepping in front of a captivated, high-profile audience on a nationally watched weekend. You have borrow fees already approaching the critical threshold of 25%. What happens to this stock if Bradley walks off that stage having delivered a demonstration that generates genuine excitement and media coverage? Could that single event be enough to push borrow fees past 25%, trigger the first meaningful wave of short covering, and send DVLT gapping higher when the market opens on Monday morning? Here's exactly how we play it. The technical roadmap for March 16th through March 20th is built around discipline and confirmation. The primary entry zone remains the structural floor between 64 cents and 67 cents. That is where the thesis has the best risk-to-reward profile, and chasing above it introduces unnecessary risk. The first confirmation level to watch is the 50-day moving average sitting at 78 cents. A reclaim of that level on above-average volume is your signal that institutional buying has returned with conviction. From there, the next key target is the Holy Grail resistance at 80 cents. A clean break and hold above 80 cents on meaningful volume opens the technical path toward 88 cents, with the ultimate near-term price objective being a complete fill of the gap to $1 even. The threshold DVLT needs to maintain for continued NASDAQ compliance. The synthesis here is a clash between two powerful and opposing forces. On one side, artificial compression, 96 million shares of unauthorized supply that a federal lawsuit is actively working to eliminate. On the other side, a convergence of mechanical and fundamental pressure that grows stronger with every passing session. 497% analyst upside, 3,000% institutional accumulation, 26% of the float sold short, and borrow fees approaching the squeeze threshold. As the illegal selling is restrained and ultimately halted, the compressed spring beneath this stock has one direction to move. Stay disciplined in your execution. Entries belong in the 64 to 67 cent zone. No volume confirmation means no conviction add. And keep a live eye on those borrow fees. Any sustained move above 25% is your early warning signal that short squeeze mechanics are beginning to activate in real time. Everything discussed on this channel, including all price targets, technical levels, institutional flow data, and analysis, is strictly for informational and educational purposes only. Nothing presented here constitutes personalized financial advice, a recommendation to buy or sell any security, or an offer or solicitation of any kind. All investing carries significant risk, including the potential loss of your entire principal. Past performance and historical price patterns are never a guarantee of future results. Please conduct your own thorough due diligence and consult with a licensed financial professional before making any investment decisions. Smart Stock. SAM is an independent educational channel and assumes no fiduciary responsibility to its viewers. The data is clear. The floor has been tested and held with precision. The institutions are loaded. A live, high-profile catalyst is unfolding this weekend, and the technical coil is set. The only variable remaining is execution. Here's the question I want you to answer in the comments right now. If Nathaniel Bradley delivers a standout performance at the Luminary presentation this weekend, what is your personal price target for DVLT by Friday's close? And do you believe 80 cents gets reclaimed before the week is out? Drop your number below and let us see where the Smart Stock SAM community lands on this one. I read every single comment. If this analysis gave you an edge today, hit the like button right now. It takes 1 second, and it directly helps this channel reach more retail investors who deserve access to this level of analysis. If you are not yet subscribed, click the button and ring that notification bell so you never miss a price target call or a technical breakdown. And if you want to see this video rise on YouTube's Hype Leaderboard, engage with it in the first hour after it goes live. Your comment, your like, and your share are the algorithm fuel that puts this content in front of the investors who need it most. Until next time, this is Smart Stock SAM. Stay disciplined, stay data-driven, and as always, let the whales show you the way.